Hello, hi students. In today's session, we'll go through how reorganization is accounted under Ind AS 103. How reorganization is accounted under Ind AS 103. So we'll go through a couple of examples in today's session so that it will be very easy for you to understand the concepts. So in the first example, we have a company X, which is ultimate parent company, and it is given that the company X is having multiple divisions. So you can see in the divisions here. So company X is having company Y, company Z, company M, and other subsidiaries. So here company Z is into the retail business segment and company Y is also into retail business segment. But the stake of company Z in terms of retail business segment is significant as compared to company Y. So that's what it is given. And it has been decided that company Z will buy company Y from company X. Right, so that's a reorganization. It's being talked about in this example. Okay, so here company Z acquiring company Y from company X is covered under Ind AS 103. So this is clearly the business combination. So company Z acquiring company Y from company X is covered under Ind AS 103, and this is also technically called as common control combination. So as from X perspective, there is no change as a result of reorganization. So as long as the before reorganization and post reorganization, if the control is with the same shareholders, then it is called as common control combination. Okay, then we'll go through the next example. So in this example, there are four shareholders, shareholder B, C, D, and E, and there are two companies, company ABC and company XYZ. So shareholder BCDE have the equal stake in company ABC, and they also have equal stake in company XYZ. So that's what it's given in this example. So in this example, we have to refer something called Appendix C of Ind AS 103, which defines the common control business combination. So how common control business combination is defined is that so all the combining entities are ultimately controlled by the same parties. So all the combining entities are ultimately controlled by the same parties. So that's how it is defined. And also this appendix C states that an entity can be controlled by a contractual agreement with parties, and those parties may not be subjected to Ind AS reporting. So this is also important. So the control can be with certain firms. They may or may not be subjected to follow the Ind AS reporting. Okay. So since there is no compulsion that they have to follow the Ind AS reporting, so it is not necessary that the combining entities to be included under the same consolidated financial statement. So if they have to follow Ind AS reporting, then consolidated financial statement would be applicable. But if those entities doesn't have to follow the Ind AS reporting, then there is no need to consolidate the financial statement post reorganization. Okay. And in the given example, there is no contractual agreement between BCDE that who will have effective control over ABC and XYZ. So it looks at all the shareholders. I mean, there are only four shareholders, but all the four shareholders will have the right to control the operations of ABC and XYZ. But there is no single shareholder or there is no agreement with one or two shareholders that they will control the operations of these two companies. Since there is no such agreement, we cannot conclude that this is under one common control. So ABC and XYZ are not said to be under one common control. It's because even though there is a joint agreement to control the operations of ABC and XYZ Limited, this joint control should be with all the stakeholders, not to any specific stakeholders. So then, so to qualify as common control, it has to be lies with one shareholder or one group of shareholders, not all shareholders. Okay, then let me move to the next example. So in this example, ABC Limited is ultimate parent company and ABC owns 100% shares of X on 1st April 2010. Okay, and ABC also acquires 100% shares of Y from 1st April 20, you can take 2017. Okay, then on 2nd April 2017, ABC Limited transferred shares of Y Limited to X Limited. Okay, then we'll go through the answer. So here company X acquiring company Y from company ABC. So company X acquiring company Y from company ABC, which is squarely covered under Ind AS 103 and business combination accounting to be followed. But this is technically called as common control combination. As from ABC perspective, there is no change as a result of this reorganization. However, acquisition accounting should be followed by X Limited. That's a independent. So the acid test to assess common control combination is that before and after the reorganization, the entity should be controlled by the same shareholders. Okay, then let me move to the next example. So in this example, it has been given two scenarios. So scenario A and scenario B. In scenario A, the acquirer is XYZ Limited and scenario B, acquirer is ABC Limited. And acquiry under scenario A is PQR and under scenario B is DEF Limited. And the acquisition happens on 1st October 2019 in both the scenarios. And there is a common control. Okay, but in the scenario A, both entities have same shareholders since incorporation. That's important. So from incorporation, both entities have the same shareholders. But in the second scenario, the shareholder is A, and A has invested in ABC from 2010, and A has invested in DEF from 1st October 2018. So it is not from beginning. The shareholder A has the stake in ABC as well as DEF Limited. So ABC probably it could be from beginning, that is year 2010, but DEF has been recently acquired, that is from 1st October 2018. Okay, so let's go through the answer. So we have to refer para 9.3 of appendix C of Ind AS 103. So this para says that financial information of financial statement in respect of prior period should be restated as if the business combination happened from beginning of the preceding period in the financial statement. Okay, so in scenario A, business combination happened on 1st October 2019. So the previous year financial statement, that is financial year 2018-19, April 2018 to March 2019, needs to be restated as though the acquisition happened from 1st April 2018. So was the appendix C of Ind AS 103 states. So you'll have to be very careful when you have sums like this. So the not only the current year financial statement needs to be reorganized, but also the prior year, because always when the Ind AS financial statements are presented, you will have the current year financials and you will also have the previous year financials. So the previous year financial statement needs to be restated as though the acquisition happened from the beginning of the previous year financial statement, provided the shares have been held as on those date. But in scenario B, you can see that shareholder A invested in DF only on 1st October 2018. So if you take the previous year financial statement, which is starting from April 2018, so as of April 2018 till September 2018, shareholder A has not invested in DF. So those year financial statement need not have to be reinstated. So you have to reinstate only from 1st October 2018. Okay. And of course, for the current year, April 19 to September 2019, the results of DEF Limited should be included in ABC. Okay, then let me move to the next example. So in this example, entity A owns 100% equity of entity B from 1st April 2011. And entity A also owns entity C, which arranges loan funding from a financial institution. And the loan fund is effectively used by entity C to acquire entity B from entity A. Okay, then consideration is 200k INR and fair value is 150k INR and carrying value is 100k INR. So that's the key of this sum, and let's go through the answer. So here acquisition by entity C of entity B from entity A is a common control business combination, as all the combining entities are ultimately controlled by the same entity, which is entity A. Okay, and let's also refer to para 8 of appendix C of Ind AS 103, which states that the common control business combination shall be accounted under pooling of interest method of accounting. So there is a method called pooling of interest method, and for all the common control business combination, this pooling of interest method of accounting needs to be followed. So as per the pooling of interest method of accounting, the assets and liabilities of the combining entities are to be stated at carrying value. It should not be at fair value, it has to be at carrying value. That's important. Okay, here since entity C is not carrying any business, and hence the transaction between entity B and entity C cannot be business combination. So it is mere reorganization of entity B. So as a result, B's assets and liabilities are included in entity C consolidated financial statement at their carrying value and no fair value profit to be recognized. Okay, then we will go through some significant differences between Ind AS 103 and the Accounting Standard 14. So under Ind AS 103, it actually guides all types of business combination, but Accounting Standard 14 guides only the amalgamation, and Accounting Standard 21 talks about consolidation of financial statement. And under Ind AS 103, all the accounting is done at fair value as on the date of acquisition. But as per the amalgamation, in the nature of purchase, accounting are done at carrying value. So that's a significant difference between Ind AS 103 and Accounting Standard 14. Fair value, fair value is permitted only to some extent. And amalgamation in the nature of merger, pooling of interest method is followed, which is at carrying value. Okay, then asset acquisition. So asset acquisition both under Ind AS 103 and under Accounting Standard 14, it's almost same. The transactions that do not meeting the business combination or amalgamation are accounted as asset acquisition without accounting for goodwill. That's important. So when under asset acquisition, goodwill or capital reserve are not getting accounted. Then acquisition related costs like stamp tax, it's all expense stuff under Ind AS 103, and under Accounting Standard 14 it is generally capitalized. Okay, then goodwill is not amortized, but it's only tested for impairment under Ind AS 103. Under Accounting Standard 14, goodwill are amortized generally over the period of 5 years or such other extended period if justified. Then capital reserve, it's included as part of other comprehensive income under Ind AS 103. Under Accounting Standard 14, it is presented under equity. Then contingent consideration, it is recorded fair value under Ind AS 103. And under Accounting Standard 14, it is included as part of purchase consideration if payment is probable and measurable. And in process R&D, it's all recorded fair value under Ind AS 103, but there are no such guideline under Accounting Standard 14. And measurement period for provisional sums, It can be adjusted up to 1 year from the acquisition date under Ind AS 103, but no such guideline under the Accounting Standard 14. And next one, step acquisition. The step acquisition, the equity interest prior to the consolidation needs to be measured at fair value. Step by step basis based on each step of acquisition should be followed under Accounting Standard 14. Common control acquisition pooling of interest method is followed, and under Accounting Standard 14, if the merger happens as part of court order, then in the court order itself they would have specified what kind of accounting method needs to be followed, and such method should be adopted under Accounting Standard 14. Done. Okay. So then we will go through a couple of the full examples of how the business combination accounting is done. So probably you can just go through the first example here. I have also given the summary of this example. So here Enterprise Limited has two divisions called laptop and mobile. And laptop is profit making unit, but mobile unit is loss making. And division wise balance sheet, it's already given in the example. And now we have a turnaround limited, which is supposed to be the group company. Purchase the net assets of mobile division for rupees 25 crore, and consideration is paid by issuing equity shares of 1 crore whose face value is 10 and issued at a premium of 15. So total consideration is 1 crore into 10 plus 15, which is 25 crores. And one shareholder of Enterprise Limited has 52% stake in the company. So this is the summary of the question. So now we'll go through the answer. So here any other alternative set of entries might be possible, but I have tried to give, yeah, the standard journal entry that needs to be followed. So if you see the question, so here the mobile limited is getting demerged. Okay, uh, so we will make the entries for the demerger. So so here the loan fund, which is the credit or liability under mobile divisions, that's debited, and current liability, which is another liability under mobile division for 400 crore, that's also debited, and provision for depreciation, which is the credit balance or liability, that's also debited, and property, plant and equipment, which is the gross block under assets, that's credited, and current assets also credited, and the balancing figure is the capital reserve, that's getting credited. Okay, so this journal entry needs to be posted to remove all the assets and liabilities of mobile limited, sorry, mobile division from the enterprises limited. Okay, it's clear. Then next step is under enterprise limited, after reorganization, how the balance sheet will look like. So after reorganization, it will have only the laptop unit, and all the balance sheet under laptop unit will continue to be carried out. So they have the net PPE of 25 crores and net current assets of 200 crores. So these two will continue to be under the asset side of the balance sheet. And under the liability side, we already have the equity 25 crore that will continue, and other equity 175 crore that will be continued, and current liability 25 crores that will be continued. So this is how the reorganized balance sheet of Enterprise Limited will look like. Okay, then we'll also go through the balance sheet of Turnaround Limited. So here the mobile unit balance sheet will be replaced here. So under crore of property, plant and equipment of mobile unit will be under Turnaround Limited balance sheet, and other current assets 500 crore will continue, and under liabilities you will have the equity. So here 10 crores of equity is issued by the Enterprise Limited, so that 10 crore will be shown as equity share capital. And other equity, it's a kind of balancing figure. I will explain you. I have given a note below. And the financial liability will be taken over by Turnaround Limited, and current liability also will be taken over by Turnaround Limited. So your total of asset side is 600 crore and liability side is 600 crore. Okay. So note 1, equity 1 crore shares at face value of rupees 10. So totally 10 crore. So that's what we have, the equity 10 crore here. And at note 210, how it comes is, so loss taken over 100 crore under this by Turnaround Limited by issuing additional equity shares of rupees 10 crore. Okay, so loss taken out is 100 crore and additional equity issued is 10 crore. So in total 110 crore. That's what it's reflecting here. Done. Okay. Then let's go through the next example. It's also almost a similar example of what we have just seen. So here a company called Maxi Mini Limited. So I will go through the summary of the question. So we have Maxi Mini Limited has two divisions called Maxi one division and Mini is another division. Okay, and the balance sheet as of 31st October 2022 it has been given, and a new entity called Mini Limited is formed to take over the all assets and liabilities of Mini division. Okay, so this Mini Limited is also kind of a same group company, and it's a common control business acquisition. And in terms of consideration, Mini Limited allotted 5 crore shares of rupees 10 each to members of Maxi Mini Limited. Okay, so then let's see what is the journal entry that needs to be passed by Maxi Mini Limited to affect the demerger. So here the Mini Limited is getting demerged and resulting company will be Mini Limited. Okay, so it's just simple. All the assets and liabilities needs to be removed from Maxi Mini Limited. So you see the Maximity Limited had current liability of 100 crore under mini division. So that needs to be removed by debiting current liabilities. Similarly, loan fund of 100 crore, provision for depreciation 100 crore needs to be debited. And this loss on reconstruction, it's a kind of balancing figure. And in terms of credit, whatever the assets held by Maximity Limited under the mini division needs to be removed by crediting those assets. So PP is one of the asset that needs to be credited, and current assets is a second asset that also needs to be credited. Okay, so so the balancing figure 300 crore, that's the loss on reconstruction, that will be debited. So your total of credit is 600 crore and total of debit is also 600 crores. So this is a first step needs to be followed when the reconstruction happens. Okay, then the next step is in the Maxi Mini Limited after reconstruction how the balance sheet will look like. So here it has been given before reconstruction how it was and after reconstruction how it would be. So in terms of PPE, before reconstruction it was 300 crore and Mini Limited is now removed, so the only Maxi Limited will be carried over after reconstruction. Similarly, other current assets earlier 700 crore and after removing Mini Limited division, remaining 400 crore will be there. And in terms of equity, the equity will continue as such. And other equity, it's a kind of a balancing figure. And financial limited, 100 crore relating to Mini Limited. So post reorganization, this will not be there. And current liability also from 200 crore, only 100 crore will be carried out. Okay, so now we'll go through how the balance sheet of Mini Limited will look like. So Mini Limited will have only the Mini unit and all the assets and liabilities of Mini unit will be replaced here. So PPE of 200 crore will be there, other current assets 300 crore will be there. So total asset is 500 crore and the fresh equity issued is 50 crore and other equity, this is a kind of balancing figure, and the borrowing will continue, current liability will continue. Just a simple merger. Yeah. So here we can do one test. So before reorganization and the post reorganization, the net asset equity value per share needs to be same. So here when it was maxi mini limited, the total share is 700 crore and number of share is 5 crore. So 140 is the per share value, per share net asset value. And post merger Maximity Limited, the net asset is 400 crore for 5 crore worth of share. So per share is 80. And Mini Limited 300 crore net asset for 5 crore share. So it is per share is 60. So 80 plus 60 140. And before demerger was also 140. So there will not be any change in case of common control acquisition. The pre-demerger and post-demerger, the net asset equity value will remain same. What can change is kind of intrinsic value, we call yield valuation. So post-demerger, the yield valuation and the ability of the company to generate profit might get varied, but net asset value per equity share both remain same. Okay, so with this, let me stop today's class. We'll again catch up in the next class.